Good afternoon, everybody, and welcome to this edition of Think Technical for Monday, 8th of March. My name is Carl Capilingua. I'm the market analyst over here at Think Markets, and it is a pleasure to be with you as we delve into everything chart-related for the next 10 or 15 minutes. The Think Markets difference before we get started, though, is substantial. $8 flat rate trades, your own holder identification number, unlimited phone support, and of course, no hidden platform or subscription fees. 4 fantastic reasons to make sure your next ASX share trade is with us. The agenda for today is to have a look at the macroeconomic overview. So we'll look at the key charts from around the world, bring that close to home, see what's going on with the Aussie market, and then have a look at a few Aussie stocks of interest. Okay, let's head over to the charts and we'll kick off with a look at the Australian 10-year government bond yields. Now, it's been all about bond yields recently, hasn't it? Bond yields are heading up, stocks are heading down as a result. Now, don't forget that bond yields move inversely to bond prices. So this rise in bond yields is actually being caused by a sell-off in bonds. Now, bonds are typically a safe haven asset, aren't they? You tend to go to bonds in times of uncertainty. The bottom line is if investors are selling bonds, they're realizing a lot of cash from those bonds. And that cash needs to go somewhere. And eventually, I do believe it will find its way into the share market, especially when shares are considered to benefit from this very strong long-term growth picture that we've got at the moment because of all the stimulus that central banks and governments are throwing at the economy post-pandemic. But yields are also a problem as well. Rising bond yields are a problem as well because it undermines company profits. So number one, these long-term government yields are usually used to set borrowing rates for companies and for us as well. Of course, if company borrowing rates go up, that means higher costs. And if borrowing rates for us consumers go up as well, we've potentially got less money to spend at those companies. So that means lower company revenues. So higher costs, lower revenues means lower profits. That's not great for companies, of course. The other problem is analysts like myself, we use something called a discounted cash flow model. And when these long-term government yields go up, we tend to raise this. It's a little cell in our spreadsheet. It's our discount rate. And when those discount rates go up, it supports lower valuations for companies. So it's a bit of a double whammy for companies, and that's why the market's responding poorly here to these rising yields. Potentially lower company profits, and we can only support lower valuations for companies. So the impact is real. It is important. This is a big deal for us. So where do we think we're going from here? Well, we did see rates top out around about 1.97%, and that was on the 26th of February. On Friday, we saw them get pretty close, and the market wasn't looking great on Friday at all, was it? And we saw that top out at 1.87%. But the good news is that today we're coming back down again. We're forming this lower peak here, and the importance of that is lower peaks typically indicate building supply on the chart and lessening demand. Now, because this is inverse, it actually means building demand for bonds and lessening supply. Either way, the good news is we should see bond yields come back as a result of this pattern. It's not a lock because we're nudging towards those highs of the session today. That's a little bit uncomfortable, but assuming we do form this peak, we can move probably back into that 1.6, 1.5 level and just give the stock market a little bit of breathing room. And that's all I think we need from this episode is a little bit of breathing room to help us refocus, probably the best way to put it, refocus on those positives for equities going forward and then move higher. We will learn to live with these slightly higher rates. It was bound to happen eventually. Rates couldn't stay at those low levels below 1% forever. They had to go up. And if we can just get them stabilized around that 1.5 level, I think that is supportive for stocks in the long term. Switching gears completely now, we're going to have a look at Bitcoin. You know I'm a long-term Bitcoin bull, and that is because of this wonderful long-term uptrend we're seeing here on the chart. That's the dark green zone. The short-term trend is the light green zone. That's also very supportive as well, and quite literally so. It's a point where the price tends to be supported. We can see time and time again that short-term trend is where the price comes down to and then bounces off. And certainly it seems to be the case this time around. Now, I have been flip-flopping in the short term on Bitcoin because I've been a little bit bedazzled by some of this choppiness in here. And I guess I have to remind myself as a technical analyst, look, just take a step back. Don't focus too much on the short term. Look at the longer term. And it is positive. And we are actually starting to see, even in the short term now, some signs of building demand through here. So we're having another higher trough set last week at 46,290. That comes on the back of this peak here being higher than this little mini peak here. We are still below this major peak here, and that's going to be the key level looking upside. but I do think the short-term trend is becoming more and more constructive every day for another move to the upside on Bitcoin. A very, very quick look here at US 10-year yields, because we've kind of discussed the concept here with the Australian ones. These ones not showing the lower peak, still pushing a little higher. That's uncomfortable, but we want to see how they go tonight, and we'll look at the last one in this database before we switch to the next database for crude oil. I might just zoom out a little bit here, and we can see that, get rid of that. Leave it there, it doesn't matter. We can see that we've closed above that key level from 8th of January 2020, and that was the high pre-pandemic of 65.65. So that is very, very constructive. Short-term uptrend, long-term uptrend is becoming quite well established now, actually. That's very encouraging. And, we're certainly a long, long way away from the depth of the pandemic here, where if you had a barrel of oil, which you would normally expect is worth something to you, you actually had to pay somebody nearly $40 US to hang on to that barrel of oil for you until your contract expiry. So it is an amazing turnaround. You've got to give the Saudis and the Russians some credit for sticking to their quotas, and of course the rest of OPEC plus. But it looks like it's onwards and upwards from here, and that will have ramifications for our energy sector, which we'll discuss in just a second. Okay, changing databases and changing gears just a little here. We're having a look at the Nasdaq Composite first up. This is the key technology stock index from the USA. What is key here is this fantastic candle from Friday. I'm going to zoom in on that one because it's really important for me. When we see a higher open and then this huge sweep down. So market thinking we're going to rally today, and we get this huge bout of selling to push us down, a few hundred points. This total decline here is about 12.5% from that 14,176 high. Incidentally, this decline here is about 12.8%. So it's funny how similar these two pullbacks are. This one, I think, took 13 trading days. I think this one was about 12. So some similarities again there. But nonetheless, we start higher, we come back quite sharply, and then by the end of the day, look at all this demand that's come in to close us near those highs. So you get this real changing of the guard between this supply side market where people are quite panicked to bang, someone has stepped in here big time. So big money has come in not far away from that long-term trend zone and said, this is our buy zone. This is the point we want to get in at. And it does catch the market off guard. The people who have been selling, they're in cash now. And if the market heads back up, that's going to make them pretty uncomfortable. They're going to want to get that cash to work, and they can contribute even to this extra demand that's in the system from these long-term buys that are coming in, as evidenced by that high close. We need to see a little bit of confirmation for this. If you go back to that September episode we did come back and we did test that low. Then we rallied and we came back. We really tested it again, and it's important to see those higher troughs come in. It could be here, it could be here down the track, but it's not just plain sailing, go straight back up to the top now. We will go through a process here of consolidating and holding that. But if we can see some troughs put in higher areas, then I do think this is becoming very constructive for higher US equities, and that's obviously going to be supportive for us back home. So let's head back home here. I've already got some little circles drawn in here just to show that we also have our rising troughs. We didn't see as much of a pullback, not nearly as much of a pullback in the Australian market as we saw in some of those risk-on equity markets from around the world, and that's because of this one here, the financial sector over here, so strong, and it's one of the few sectors that benefits when the yield curve is steepening, because we know that banks, they borrow at the very low short-term rates that are being set in place by central banks, and then they lend to us at higher long-term rates, which tend to be set by the market, and we kind of price takers on those, we have to accept them, and that increases their profit margins when that yield curve steepens. So this rally here has prevented anything too disastrous happening here, which I think is a good thing because it keeps us in this consolidation zone. If we get to the bottom of this zone and then get below it, it starts to tip out people who got in here. We know lots of people got in here. They're still making money. If we get down here, they're losing money, and that makes them nervous. So it's helped us not be there. I think that's the important thing. And we set, as I said, this really nice base pattern here to push not just into 69.38, but potentially even higher into this old higher at 71.97. So the technical picture for the ASX 200 starting to look very constructive, led by, as I said, the financial sector, which looks amazing. It is hands down the best sector. I think the second best sector, though, is the energy sector. I know the bit on the far right is not as as spectacular as the financial sector, but it does also have this nice consolidation through here. And I think that's a good base to push higher. And we did see those very strong energy prices earlier on in the presentation. We'll have some energy stocks for you to look at a little bit later on as well. They're the two best. Remain cautious on gold. I still think there's some downside for gold. And for the healthcare sector, that's still looking pretty iffy as it has broken through a key technical level there. Look, the rest are a bit of a muchness. Technology might be interesting here if you think the Nasdaq's going to bounce. It is in this long-term support zone here, but I just don't think we have the firepower in our technology sector that the Nasdaq has. So it's not one I would necessarily be running out and targeting just because the Nasdaq is going to rally or our expectation is along those lines. Apart from that, I might just quickly mention nickel. That was an interesting one from last week on the basis of a major supply side shock. And I did have a spot on Ausbiz this morning where I explained that, so maybe get onto the Ausbiz website and have a look for my spot this morning. I won't go into it today, but it's all about fundamentals, and here we're all about technicals. But the key is that we didn't really rally off those lows like we did on the Nasdaq. We saw that big rally on the Nasdaq telling you demand's coming in. Didn't see that here, so we could see further downside for nickel. Now that's important if you're holding nickel stocks, and we have been very positive on a particular company there called Nickel Mines. It's come back to the bottom of the range. I think it's still holding here, so not panic stations yet, but just monitoring that closely. And IGO is another one we have had in ThinkTechnical as well. You'd be way ahead on both of those, even with this recent pullback. But I do think we need to watch this nickel price closely, but I'll update you on those if I think something really terrible is going on. Okay, let's head over to our stocks of interest for today. And I did run a technical scan before the market opened and came up with this short list here. And I'll just spend probably a bit more time on the first one because it'll set up the rest of them, because basically they're the concepts are a carbon copy of what we're going to discuss now. So the first step I'm looking for, because this is a long scan, we're looking for stocks to buy, is a short-term uptrend. I like this to be well established within this long-term uptrend as well. Now that long-term uptrend preferably is well established, but it could also be establishing itself, and we'll see some setups where the long-term uptrend is about to switch to the upside, but we have that short-term uptrend well and truly in place. So this one is 3DP. The ticker code is up here, or it's over here if you get lost during today's presentation. I probably will forget to mention the ticker code every time, so just check those out for yourself. This one is Pointerra. The name is here as well. But a nice short-term uptrend, a nice long-term uptrend. The next thing I look for is support and resistance. So I want to be pulling back to a support level, for example, this one here at 67.5, and then bouncing off that, looking for the price action to demonstrate a bounce off that level. We're certainly seeing it. Now that is a static level of support. It's not going anywhere. That peak at 67.5 is going to be there forever. We also have these dynamic support levels coming from our moving averages. Our moving averages, as we talked about earlier on, tend to act like a trampoline when the price comes down and they push prices back up. So the combination of this bounce off this static and dynamic support zone, in addition with this nice uptrend, is why I'd be looking to buy this one anywhere around this sort of 75 to 80 cent level, on the basis that this uptrend will perpetuate itself. Look, this is a buy. There are other stocks in here that we're just recovering because we have covered them before in the past. So we have covered this one, for example, on the 8th of October, 2020 at 48 cents, which, I don't know, somewhere down here probably on this breakout here. So you're doing very nicely out of that one. So definitely a hold there, but if you're not in it, then happy to buy around current levels. Contrasting this one, which, look, I'm happy to buy around current levels, but it's probably more just of an update and a hold on that one from previous coverage. But look, there's nothing in here that would suggest you wouldn't just go out and buy it now. We actually having quite a nice little rally off that dynamic support zone, not far away from the static support zone. They're at 43.5, and the trends are impeccable. You can't fault that one. So that's A4N, Alpha HPA, compared to Pointerra. Let's keep rolling along here. This one is Aeris Resources. We've covered a couple of times before. I think this is more of a hold. It has pulled back, so if you're concerned about this pullback, let's watch and see how it goes here at this support level. But otherwise, happy to hold on to that one. Ticker code AIS. Bet, I think this is actually more in the camp of a buy. which is, of course, therefore still a hold. I mean, 54.5 cents was the first time we covered this, so you're doing very well on that one. So hang on to it. If you don't have it, then it's doing all the right things, isn't it? So it's pulling back to that support zone, both in terms of static and dynamic. We're starting to see a little bit of a rally here, a bit disappointing today, but we want to see how that closes. But otherwise, I think this zone is going to hold. So if you're not in it, you might want to look to get in it around current levels, but otherwise we're a hold on that one. Blackmores, you can see no little message down here to say that we've had it. So this is the first time I'm covering this one. It's starting to turn around. This is one of those where we're looking for the establishing long-term trend. It's not there yet, but it is moving into this orange zone from having previously been a downtrend. And we have to start somewhere with the long-term trend. You can just wait until we're seeing all green on the screen, but you would be giving up quite a lot of price. Having said that, you're taking, I think, a lot less risk by going when you're seeing, that long-term uptrend and the short-term uptrend in place. Here we have a short-term uptrend. You can see the light green zone, and we're taking a little bit of a punt that long-term uptrend is going to establish. And punt is kind of the operative word. So establishing trend means higher risk, established trend means lower risk. And I wouldn't touch this one until it broke through 83.71, and that would further drag up these moving averages and establish that long-term trend. But putting you on notice for Blackmores. BSE is one we have covered before. The trend is established, therefore lower risk. Having said that, it's clearly a small capitalisation stock, isn't it? You can see it's a little bit sketchy. It's 30 cents. Compare that to Blackmores. It's an $80 odd stock. So think about how your portfolio sits. Are we adding smaller speculative stocks? Are we adding more blue chip type stocks? I'm not telling you what to do, but I'm just making you aware that if you're buying on the basis of some of this analysis, to really consider some of that risk within your portfolio, not just in terms of whether the trends are in place, but in terms of the market capitalizations. Okay, so base resources, we're going to go very, very quickly here. If you've got it we mentioned it just last week, I'm happy to hold it. Otherwise, happy to get in, continue to get in at current levels. BWX, again, it's one we've covered before. It's not a lot higher from where we got in, but happy to continue to buy this one now. So this is not just a hold, I'm happy to continue to buy. Yes, the long-term trend's a little bit flatter, but we do get these flat spots before we move back into the uptrend. So happy to go on that one around current levels. Next one is Candy Club. This is one we haven't featured before, but I am looking at this nice short-term uptrend, this nice long-term uptrend. We are pulling back to a very strong support zone, not just from this little trough here, but from these previous long-term peaks here. So they should offer support, and it's also trampolining out of the light green zone, our moving averages. So happy to buy on that basis around current levels. So this is a new coverage or an addition to our coverage in our Candy Club, and we'll continue to watch this one down the track, much as we've watched many of the other ones we've presented so far today. So happy to go around current levels there. Ticker code CLB. This is one we've had before, Clearvue Technology. So that was 27.5, the entry. It's currently around 40, so pretty happy with that one. Definitely holding if you've got in it from that coverage. And if you're not in it, it's doing everything else we need to do. I shouldn't have to say it all again. Just rewind me and play me back from the last 6 or 7 or so, but happy to get in around current levels. Dropsuite is one we haven't actually covered in ThinkTechnical, but we did do it in one of our webinars as a buy. And it was, I'm going to say it was probably around 13 or 14 cents at the time. So moving along quite nicely. The trend is still very much up. If you're not on it, then happy to get in around current levels. Just pulling back to this short-term zone within the context of this very well-established long-term uptrend. E25 is certainly one we've covered before, around about, I'm going to say, 96 cents. So you're doing pretty well on that one. Up around $2. That's a typo there. Let me fix that for you. That high there is 2.00 on the knocker. And you look, just if you're in it from there, clearly I would hold it on the basis of this strengthening long-term trend. And if you're not in it, I think you can still buy it here. I think that still looks very, very good. Into the next one, EVO. This is one we haven't covered before, so new coverage here. Looking at this setup here where we're building some support in and around this $1.10 level. Short-term trend has got a little bit of work to do, so look, maybe you can buy it on a little bit of momentum here, maybe through 130 if you're a bit more conservative. Yeah, look, I think that's probably the way to go. Otherwise, we do have that long-term uptrend in place. The next one is EVT. This is one we have covered before. It's doing quite nicely, actually. So definitely holding from there. If you're not on it, then happy to buy in and around this $11 zone, or if it does break through $12. EXR, this is new coverage here. We haven't covered this one before. Look, stairway to heaven on that one. Great short-term trend, great long-term trend, breaking through this little resistance zone here. So happy to jump onto that one at current prices. We do like to cover our ETFs as well. I've got 3 in here. This is the first one, fuel. So if you can't pick an energy sector stock that you'd like, and in addition to that, you want to have a look outside of Australia, and this is a good one to look at. So that is fuel. It's the Betashares Global Energy Companies ETF. It's currency hedged as well, so the impact of the Australian dollar should be fairly minimal there. But for the reasons we talked about, nice short-term trend, we can see that this long-term trend is being dragged up a lot quicker than perhaps some of the other ones, for example, Blackmores, and therefore I think that one looks pretty good. So happy to be on that one. FYI Resources, if you're on it from 21, definitely sticking with that one. If you're not on it, maybe you want to buy in and around that sort of 44 area there if you get a pullback, or you may be forced to buy on a breakthrough 51.5, but definitely stick with that one. Good Drinks Australia, this is a new one to add to the list. It's one I have done quite a bit of fundamental research on, and I do check out. It's quite sound on that front as well. It also produces my favourite beer, which is Single Fin. Definitely check that out as well. But happy to buy in and around this 8.5 cent level here after its pullback. I'm guessing that was for its first half results. The next one is Jupiter Mines, ticker code JMS. We do have that long-term trend becoming established here. It's pulling back to a support zone, and we're looking for it to bounce through there. I think probably want to ask a little bit more momentum of this one. So as it breaks through 35, I think is the place to get involved, rather than assuming it's going to hold here at 34. Into the next one, Karoon Energy, which is one we've covered a number of times here. You can see that as I tried to pick the bottom in the energy sectors. You can see in October a few times and then December, but eventually I got it right. So we can see Karoon Gas with a great short-term uptrend. We do see the trampolining effect off that light green zone within the context of a great long-term uptrend. It could be targeting into, what's this level up here, about 143.5. But stick with that one if you're on it. Mainstream is new coverage here. I think this looks really good, actually. So a really well-established long-term uptrend. A nice building consolidation pattern here. We see, this it's demonstrating this increasing demand through here. We need to get through this supply here at 116.5, but look, I'm happy to buy in advance of that. I think it will get through. Happy to go around this 110 level. Look, if you're a bit more conservative, wait for a break of 116.5, but happy to add that to our buy list. Also, just one we've had for a little while now. Happy to stick with that one if you're on it. If you're not, then it looks like it's breaking through this 457 level, so happy to buy here. One of those energy sector stocks that we're going to discuss today. PEX, Peel Mining. Look, I'm having a sort of look at this with fresher eyes. Perhaps it's a bit scratchier than some of the other ones. Look, it's here as an idea. Now that I'm looking at, maybe it's a bit too scratchy, but it's got some good stuff going on for it. I'll let you consider it amongst the rest of the list. Qantas, just reiterating our buy on this one. Happy to go at current levels. We're expecting this long-term trend to establish itself. If it hasn't already, it's very close. And we've got the short-term trend and looking for a breakthrough 527 really to confirm this turnaround. SRG Global, that looks pretty good, doesn't it? So we've got really, when you're going up towards the top right of the screen, that's always a good start, and just happy to buy in and around those levels. We have had a buy on this one in the past at 35 cents, so that one's tracking along pretty nicely. Happy to hold, happy to buy. Santos, this is a new addition to the list. It's about the only oil company major producer that I don't have a buy on. In fact, the other one is Beach Petroleum, which still looks terrible, by the way, but I'll keep an eye on it for you. But Santos, adding this to the buy list now, did break through 762 on Friday. It's struggling a little today, but not too concerned about that. I do want to get on board this one. So buying Santos. TWE, this is the first time this has been on the list. It's one of those higher risk turnaround play, so we're looking for a long-term trend that we're hoping to establish itself, but the short-term trend has turned up before that's occurred. It had there's some rumours going around today about a large European booze group looking to buy this one potentially, and I'm not saying there's any credence to that rumour, but certainly the market's responding to that today. I would have put this in anyway because it's one I've been watching for a potential turnaround play just on the basis of what the technicals are doing. And I do think we've got this great big basing pattern here. It's a massive basing pattern. I don't think we're going to go beneath that pattern. I think that low's been set, and I think we should head up from here on Treasury Wine Estate. So happy to just get in around current levels. This is one of the other ETFs that we've got today. So this is the Global Dividend Fund, SPDR, SPDR, I call them spiders. And then there's one down the end, which is the ZYUS, which is the High Yield Low Volatility Fund from the US. Now, not unusual to see them come up at the same time, but interesting to see them come up when bond yields are heading higher. Normally that's detrimental for high yielding stocks. So I'm not going to try and rationalize this one. I'm just going to say the technicals look very good. It's an establishing uptrend. And often they're the best ones, these turnaround plays, because there's a vacuum to the upside where people start to look back to that high. And I think this should, in theory, be a pretty low-risk, high-yielding play. And I guess if yields come down, it's got to be supportive of these anyway. So I can only see upside here. I can't see downside, famous last words, but make of that what you will. So either of those, maybe that one looks better there. WDIV just hasn't popped as much, and it's a really nice basing pattern. We'll talk about Webjet next, which is one of those travel stocks that we've seen. Event, Qantas. I nearly put Flight Centre in today. I didn't quite put it in. It needs a little bit more cooking, but got very close. Webjet here. So there's some themes coming through, energy and travel. It's that sort of recovery from the pandemic. I'd like to buy this one on a breakthrough 581. I don't think you need to rush until it gets there. And again, it's one of those high risk plays because it's an uptrend we're hoping to establish itself on the basis of this short-term trend being in place now for a little while. And then Woodside, which we have had a buy on for a little while, and just reiterating that buy now if you don't have it, or if you've got the portfolio you were thinking, when do I add some exposure to Woodside? Look, I'm happy to do it around now on the basis that we should get through that 2760 and move back into the short-term uptrend and then establish this long-term trend down the track. But it is a bit more of a high-risk play because of the nature of this long-term trend here. That's the end of that list. We have gone way over time, so apologies for that. But there's lots of stocks to look at. Lots of stocks look really good, and I want to bring them to your attention. So forgive me for that. And if you want to catch up on all of my other updates, you can head to our market news section of the website. Regular updates during the week. News, views, analysis and opinion. You can follow me for more of that on Twitter if you like. There's my handle, or the Think Markets one as well. A few webinars coming up this week and next week. We've got the 3 stocks with dividends and growth. So I'll attempt to do the impossible there. Find you 3 stocks that have dividends and growth potential. Next week, Ask the Experts, where you bring your portfolio to the table and we chat for half an hour about the stocks you're interested in. And then on the 24th of March, how to create an investing plan. A very, very important topic indeed. Another very important topic that we need to discuss is the disclaimer, which says that everything we've talked about today is general advice. Hey, I'm just here to give you ideas. It's your job now to go out and make the decision on what you want to do, and it is your decision to make. We are a regulated Australian broker. Of course, we do have some products that could see you lose more than your deposit, so make sure you read this disclaimer carefully, and if you have any questions at all, please give us a call. That's it for me today. Hopefully you got lots out of it. All the best for your trading. Until we catch up again, bye-bye for now.